What do you make of these numbers? I mean, falling short of expectations in terms of export numbers, 11.6% versus estimates at 12.4%.
Yeah, I think the export numbers is a little bit weaker than market consensus, but generally, I think the trend is pretty soft, pretty solid. And remember, in July, we had a big upsurge in the export side. So if you put the 2 months together, July and August, it does seem that China's export sector momentum has been holding up well. And if you look back to the past couple of months, China's exports overall has been generally surprising on the upside. And that is on the back of the fact that you have strong demand for medical equipment. Your tech sector exports have been holding up well. And China has been first in, first out in terms of the supply chain recovery. I think the interesting thing would be going forward, where do we see the export momentum? Can that be maintained in the coming months? We are pretty constructive on that in the sense that our global team do believe that the global goods demand will be solid in the coming months as demand recovery expands from consumption side to an inventory rebuild. And now with recent signs of pickup in business spending, including CAPEX. So in that sense, the near-term outlook for the export sector should be still on the constructive side.
And Grace, fair to assume as well that China will benefit from the reopening of Asian trading partners, also the EU as well as the US.
Yes, that's why we were saying that the outlook on the export sector will be quite constructive, because if you look back in the second quarter, well, we did benefit from the fact that China was the first to reopen its supply chain, and therefore it actually saw some near-term expansion of the global market. In the coming months, with the reopening in the other markets, including US, Europe, and the rest of the world, while you would see more production activity picking up in other parts of the world, demand will be picking up notably as well. So overall, that should suggest that the demand environment overall from the global front should be supportive of China's export sector in the coming months.
And Grace, looking at the imports, a contraction of 0.5%, how much has it got to do with China's highly congested ports at this point in time, impinging imports of iron ore, coal, as well as other materials?
Yeah, I think that is a very interesting point. We still yet to see more details of the August import data. I think what that would imply for the domestic demand side is still that we do see the investment part of the economy still being the important part of holding up further economic recovery going into the third quarter and the second half of the year. But there could be some short-term complications, as you mentioned, in terms of the inventory cycle or in terms of the operation at the port sector. But we don't see this as a signal suggesting a weakening in domestic demand. If anything, we do see investment growth will continue to be an important driver of the overall economic recovery going into the second half.
Grace, if you drill down into these numbers, you actually find that there's some news which is not really going to be pleasing for Donald Trump. For China's January-August trade period, the surplus with the US that China had was 1.3 trillion yuan. And if you look at the imports from the US, they're actually just up 0.2%. So they're not going to like it in the White House, are they?
Yeah. It will take time. I think the way we see it is still that while it will take further time for that trade adjustment to be effective, to show up further in terms of the bilateral trade between US and China. In the near term, though, while we have seen increasing signs of difficulties on the relationship between the two sides, expanding from trade to financial sector, to technology sector, to geopolitics, including issues about Hong Kong, Taiwan, and so on. Indeed, we see the Phase 1 deal between the two countries as one area which is still going on reasonably well. And so what that means is that in the near term, in the next couple of months, terms, China would still put on more efforts to increase its imports on the U.S. And therefore, in that sense, the phase one deal is indeed one of the a few areas of the bilateral relations which is still going on fine at this moment in time.
Grace, is there any read-through from this data to where we are with growth, given that the import side showing that contraction of 0.5%, perhaps may not show that the domestic market is perhaps working as well as it should be? And what does it tell us about that, that certain dual circulation policy that's being bandied about?
Yeah, it's quite a complicated issue. You raised quite a number of important points here. I would say in the near term, we have seen a very solid rebound in the second quarter GDP, when we do see growth continuing to recover into the second half. However, if we talk about the momentum of recovery, we do see the growth recovery momentum to be moderating in the near term in July and August. That's partly related to weather effect, the heavy rain, the flooding, but also partly reflecting the fact that your domestic production activity, that sharp rebound, the momentum is moderating somewhat. I think what is important going into the second half is that while we continue to see policy support on the infrastructure investment side and also with stabilizing real estate sector activity, you also still have the boost coming from the external side, as we mentioned, given the constructive global outlook. I think one key area that we are watching out for is the recovery on domestic consumption and service consumption, which has been generally lagging in this rebound phase. So how much of further recovery that we see in those sectors, consumption and services and retail sales into second half, will be quite crucial to determine how much further recovery we'll have. At this moment in time, our full year forecast for GDP growth this year is 2.5%. That means the second half momentum in terms of year-on-year growth will come back to something between 5.5 to 6%.
Grace, we've seen a pretty resilient yuan, mainly because of the weak dollar. How tolerant is the PBOC of a stronger yuan, and will that impact on exports going forward?
Yeah, I think that is a very important question at this juncture. As you mentioned, the yuan has been strengthening against the dollar on the back of a general dollar weakness trend. And at the same time, it is also reflecting the fact that your fundamentals are indeed constructive for the yuan in terms of the first in, first out of the Chinese economy, and hence the positive growth differential, as well as the interest rate differential, as the PBOC is seen to be easing, but at a less aggressive pace as the US. So if you look at the trade-weighted basis for the renminbi, it has been coming up in recent weeks, but if you look back to say since the beginning of the year prior to the virus situation, the trade-weighted renminbi was actually only modestly higher compared to early in the year by about between 1 to 2%. And given the ongoing momentum in the export sector, in the overall growth picture, it does seem that the policymakers are still reasonably comfortable with the current level of the yuan. And in addition, as we mentioned, the difficulty between US and China relations at this moment in time has actually shifted to other sectors, such as financial, such as technology, and so on, which has less to do with the renminbi. And in addition, the stronger renminbi also seem to be helping with the domestic financial market opening to the foreign investors, and therefore internationalization of the renminbi.